We're diving into one of the most influential investment books ever written, A Random Walk Down Wall Street. In this video, we'll explore the key ideas from Chapter 4. Today, we're taking a deep dive into two financial super bubbles from the early 21st century, the dot-com bubble and the housing bubble. We're going to unpack the sheer scale of wealth created and then, well, utterly destroyed. We'll explore the surprising psychology that fueled these things and, maybe most importantly, distill the crucial lessons you can take away for your own financial life.
Right. And these weren't, just minor market blips. These were huge events that reshaped whole economies. They fundamentally challenged how we think about value and risk. Honestly, comparing them to something like the tulip mania, it almost feels like an insult to tulips given the colossal impact. The dot-com burst, for instance, wiped out something like, an estimated $8 trillion in market value. That's like several major European economies just vanishing overnight.
Wow.
And the housing bubble, that nearly took the entire global financial system down with it. It was that serious.
Okay, let's get into it. The dot-com era first. What made this bubble so unique? How did it even kick off?
Well, bubbles often spring from something new, right? Groundbreaking technology, or maybe a revolutionary business opportunity. The internet was this really potent combination of both. It promised to change everything, how we get information, how we shop, connect, everything. And this double whammy created just an unprecedented surge of wealth, but then just as quickly, an equally unprecedented destruction of it.
Yeah, it really sounds like a runaway train.
Yeah.
Robert Schill talks about these positive feedback loops.
Yeah.
Can you sort of walk us through how that actually played out in the dot-com craze?
Absolutely. So imagine the price of internet stocks starts to just creep up a bit. That rising tide encourages more people to buy in, which then gets more media attention, right? Which draws in even more buyers. And those early investors, they're making easy money. They tell their friends at parties how simple it is to get rich, driving prices higher and higher, pulling in more and more people. It's almost like a greater fool game, or maybe even a Ponzi scheme, really. You constantly need new, arguably more gullible investors to buy from those who got in earlier, and eventually, you just run out of greater fools.
And it wasn't just small investors, right? Even the biggest players on Wall Street got caught up in it. I remember hearing about Goldman Sachs, this venerable firm, claiming that the massive cash burn of these internet companies was just an investor sentiment issue, not a real long-term risk. What happened just a few months later?
Exactly. Hundreds of internet companies went bankrupt, which ironically proved Goldman's report kind of correct, but in a very immediate, short-term way. The cash burn wasn't a long-term risk for them because, they didn't exist in the long term.
Mm-hmm.
And back then, anyone who dared to question this new economy was immediately shut down, called an anti-technology Luddite,
The numbers themselves really show how detached things got. The NASDAQ index, it more than tripled in just over a year. And PE ratios, price to earnings for companies that were actually profitable, they soared past 100 times earnings. What did that mean for a company like Cisco, say, at its peak?
Okay, Cisco, a core internet backbone company, right? Its PE was in the triple digits. Its market cap was heading towards $600 billion. Now, even if Cisco's earnings grew by a phenomenal 15% every single year, its PE ratio would still be way above the market average a decade later.
So,
yeah. And if it kept up that 15% annual return for 25 years, its market cap would eventually be bigger than the entire U.S. economy.
it's just not possible.
It was simply unsustainable. It highlights that, look, growth alone is enough. You need sustainable profit potential. That's the real key.
And we're seeing echoes of that today, aren't we, like with NVIDIA, often called the king of AI infrastructure. What do its valuations look like right now, say mid-2025?
Indeed. The pattern, it does seem to repeat. NVIDIA's PE in 2025 is somewhere between 60 and 70 times earnings. And its market cap is nearing $4 trillion. That's almost the size of the entire German stock market.
4 trillion.
Right. Now, if it managed 15% annual profit growth, which is huge, by the way, its PE would still be above average in 10 years. And if you project a 15% annual return for 25 years, its market cap hits $13.3 trillion.
Which is just astronomical.
It would require it to grow faster than the entire global economy. It's a valuation that's become, completely untethered from any reasonable expectation of real earnings growth. When that sustained high growth doesn't materialize, even a divine stock like NVIDIA could face potentially a 90% valuation compression, just like Cisco did.
Right.
People won't say NVIDIA was a bad company, of course. They'll just remember that everyone scrambled for an AI golden ticket at a $4 trillion market cap with a 70x PE ratio.
So, okay, beyond just having a potentially good idea, what else were companies doing to jump on this bandwagon? I heard about companies just adding .com to their names.
Oh, it was wild. Absolutely wild. Just like the Oldtronics craze decades before. Companies, even ones barely connected to the internet, they just changed their names. Slapped on .com or internet. There was actually a study that found companies doing this saw their stock prices jump 125% more than similar companies just in the 10 days around the name change announcement.
125% just for a name change.
Yep. Even companies with basically no core internet business saw their stocks surge, of course. Most of these eventually became worthless.
But it got even more absurd than that, right?
Yeah.
Tell us about Palm Pilot and 3Com. That story is just unbelievable.
It really goes beyond simple irrational exuberance. So 3Com owned Palm Pilot, okay? They decided to spin it off, give shares to existing 3Com shareholders. Here's the crazy part. Palm Pilot's stock soared so high that its market cap reached twice that of its parent company, 3Com.
Wait, the part was worth double the whole company.
Exactly, which meant that 3Com's other businesses, its core networking business, were essentially valued at negative $25 billion.
Negative $25 billion. How is that even possible?
Mathematically, you could buy 3Com stock and get their other businesses for, like, minus $61 per share.
That's just broken.
The market was creating anomalies more bizarre than any accounting fraud you could imagine.
It sounds like it was just a playground for venture capitalists, too. What
Well-
kinds of, outlandish ideas actually got funded back then?
Oh, the money was flowing like crazy. In just the first quarter of 2000, you had over 900 VC firms pouring, $15.7 billion into more than 1,000 internet startups. A lot of them were just chasing trends, no real business model. We saw companies like DigiSense. They wanted to make websites emit smells.
Emit smells. Seriously.
Or Flues, this alternative email currency that got tangled up in a scam with stolen credit cards, despite their buy a dollar for 80 cents pitch.
Doesn't sound sustainable.
Not quite. And Pets.com, famous for its sock puppet mascot, right? But couldn't make money delivering low-margin dog food. There was even a website called stepkudcompany.com that just chronicled all the failures. It got millions of visitors. And the utterly foolish swapit.com. They tried to profit by actually handling the inventory of junk people wanted to trade online. The complete opposite of eBay's successful, hands-off model.
I also heard a particularly wild story about theglobe.com.
Ah, yes. Theglobe.com. Founded by two young guys in a Cornell dorm room. Basically an online message board, hoping to sell banner ads. Now, 5 years earlier, a company with no real revenue, no profit, would never have had an IPO. Never.
Right.
But in November 1998, their stock goes public at $9 a share. And it immediately shoots up to $97.
$97.
Yep. Made it the most profitable first-day listing ever at that time. Pushed the company's market cap close to $1 billion. The founders became instant elites. One of them famously said he was ready to live a disgustingly frivolous life with girls with money. This IPO was a real trigger. It basically severed the link between profit and stock price. It opened the floodgates for countless other loss-making companies to go public. Theglobe.com, by the way, closed its website in 2001. You had John Doerr, this huge venture capitalist, calling the whole era the greatest legal creation of wealth. He conveniently forgot to mention later that it was also the most devastating legal destruction of wealth.
And who else was fanning these flames? I imagine the Wall Street analysts, the ones who became household names, played a pretty big role.
Oh, absolutely. Mary Meeker, Queen of the Net, Henry Blodgett, King Henry, Jack Grubman, the telecom stock guru. These analysts were paid millions, but not really for the quality of their analysis. It was more about their ability to attract lucrative investment banking business for their firms.
Ah, the conflict of interest.
Exactly. The Chinese walls meant to separate research from investment banking. They became more like Swiss cheese, just riddled with holes. Blodgett argued traditional valuations didn't apply to explosive growth. Meeker famously said, "Now is the time to be rationally reckless."
Rationally reckless.
Yep. They even used baseball terms like 4-baggers and 10-baggers for stocks, all hype.
And they almost never recommended selling a stock, did they?
Almost never. The buy-to-sell ratio was nearly 100 to 1. You had Americans watching prices just climb and climb, thinking investing was easy money. But when the bubble burst, these celebrity analysts faced lawsuits, investigations. Blodgett became the clown prince of the bubble. Grubman was ridiculed for hyping WorldCom.
So beyond just the hype, how did they even try to justify these sky-high valuations? They must have invented some bizarre new metrics.
Oh, they did. They certainly did. In this fearless new internet world, things like sales, revenue, profit, suddenly irrelevant. They looked at eyeballs, just the
Yeah.
number of people browsing a web page, or intending customers, defined as anyone who stayed on the site for at least 3 minutes.
3 minutes. That makes you an intending customer.
Apparently.
Hmm.
Mary Meeker even praised drugstore.com because 48% of its eyeballs were intending customers. Nobody cared if they actually bought anything. Drugstore.com's stock peaked at $67.50. A year later, when profit mattered again, it was a penny stock.
Wow. That really shows how important it is to stick to fundamentals when people start dismissing traditional valuations.
It's often a huge red flag, right? Not some new paradigm.
Customer mindshare was another one of those buzzwords, wasn't it? That sounded equally crazy.
Yes. That was the one that convinced a lot of people that investors had truly, lost their minds. Like homestore.com, highly recommended because apparently 72% of internet users' time spent on real estate sites was on their listings.
Okay.
But customer mindshare didn't actually lead to property sales. Their stocks still plummeted 99%. For telecom companies, they measured miles of fiber optic cable laid, not how much data was actually flowing through it. PSINet even painted its name on a football stadium.
Just pure marketing.
Pure marketing. They just kept lowering valuation standards as prices rose, leading to this massive oversupply. Get this. A $1,000 investment in Nortel Networks stock just a year before the fall of 2002 was worth only $49. Meanwhile, if you'd spent that same $1,000 on Budweiser, drank it all, and recycled the cans, you would have gotten $79 back.
That says it all, really.
By late 2002, that Nortel investment was worth just $3.
The media played a huge role, too, didn't they?
Yeah.
So turning us into a nation of stock traders.
Definitely. The news industry, like any industry, follows supply and demand. Investors wanted internet news nonstop. So magazines like Wired, The Industry Standard, Business 2.0 just proliferated, all promising easy wealth. Jane Bryant Quinn called it investment pornography.
Strong words.
And the internet itself, it democratized access to stock info, real-time data, analyst tips, news, which just kept feeding the bubble.
And the online brokerages were pushing it hard, too. I remember those commercials vividly. They were everywhere.
Oh, yeah. Advertising heavily, promoting low fees, though, often with hidden costs, right? One ad had this woman boasting she'd wrestle its skinny little body to the ground and make it beg for mercy, talking about beating the market.
Oh, my goodness.
Another showed some guy in a post office telling his boss, just buy this stock. And the boss, knowing nothing, just buys 100 shares. It fueled just unprecedented stock turnover. People held stocks for days, sometimes just hours. Daily price swings for top stocks often exceeded 50%.
And you had something like 10 million day traders supposedly quitting their jobs to chase this quick wealth. Long term for them meant what later that morning?
It was truly insane. People would spend hours agonizing over buying a $50 kitchen appliance, but then risk tens of thousands of dollars based on advice from some anonymous online chat room.
What did the actual data show about how successful these day traders were, and how long did they typically last?
The research was pretty overwhelming. Most day traders lost money, and the more they traded, the worse they did. On average, a day trader only lasted about 6 months before blowing up.
6 months. Wow. And finally, of course, this kind of environment seems absolutely ripe for fraud.
Speculative manias almost always bring out the worst in people. Corporate management often started aiming to satisfy the immediate demands of speculators, not build long-term value. They'd use creative accounting, let's call it what it is, often fraud, to hit these aggressive earnings targets Wall Street wanted to see. Enron is the quintessential example.
Enron.
Once the 7th largest U.S. company, it collapsed spectacularly, losing $65 billion in value.
Enron was seen as the perfect new economy stock. Right?
Yeah.
What were some of their most, egregious tricks?
They created these incredibly complex partnerships, these special purpose entities, basically to hide their true financial health, hide debt off the balance sheet. One simple example. They formed a joint venture with Blockbuster. It failed. But Enron secretly partnered with a Canadian bank, which then lent Enron $115 million against the JV's future profit.
Lent the money against profits that didn't exist.
Essentially. And Enron recorded that loan as current profit. Their CFO made something like $30 million managing these supposedly independent partnerships. Arthur Anderson, their auditor, even signed off saying the books fairly presented the company's condition. Clearly not the case.
Unbelievable.
There was even this scam within the scam, where the top execs, Ken Lay and Jeff Skilling, set up a completely fake trading room just to impress Wall Street analysts who visited. They bought top-of-the-line equipment, had employees pretend to be making trades, even painted phone lines black on the walls to look busy.
They faked a trading floor.
They did. Both Lay and Skilling were later convicted of conspiracy and fraud. One Enron employee who lost everything famously sold T-shirts with let's just say, a very crude and angry message directed at the executives.
And Enron wasn't an isolated case, was it?
Yeah.
This was more widespread.
Not at all. Telecom companies were exaggerating revenues by basically swapping fiber optic capacity with each other, trades that generated no real cash flow. Tyco used cookie jar reserves.
What are those?
It's a sneaky accounting trick. You stash away earnings in good years so you can dip into the cookie jar to artificially boost profits when times are leaner. Makes earnings look smoother than they are. WorldCom inflated profits by $7 billion just by reclassifying routine expenses as capital investments, pushing costs into the future. You had CEOs acting like chief embezzlement officers, CFOs like chief fraud officers. There was even a dark joke that EBITDA actually meant earnings before I trick the dumb auditor.
Wow. It's just hard to believe so many people fell for all this.
Well,
Looking back, what's the main takeaway for you from the whole dot-com bubble?
I think we just should have been far more discerning. History shows us again and again, right? Even hugely transformative technologies, railways, airlines, television, didn't necessarily make the early investors rich. The key isn't just societal impact or even industry growth. It's whether the industry and the specific companies in it can actually generate and sustain profits. All these excessively prosperous markets, they eventually succumb to gravity. Making money in the stock market isn't that hard over the long term. It's avoiding the irresistible temptation of these short-term get-rich-quick schemes that's really, really difficult.
So if you had to point fingers, who were the main villains here? Or is it more complicated?
Look, you could definitely point to the brokers pushing junk stocks, the analysts who became cheerleaders just to win investment banking deals, the corporate executives cooking the books. But maybe the main reason the bubble inflated so much was that individual investors were just susceptible. Susceptible to that contagious greed, the allure of easy money, the fear of missing out. I had a friend, right, built a solid, diversified portfolio over years. But he kept going to cocktail parties, hearing about friends tripling, quadrupling their money in internet stocks.
This FOMO kicked in.
Totally. He wanted some of that excitement. He bought into boo.com, remember them? Online fashion retailer trying to sell clothes no one was wearing yet at full price.
Oh, dear.
Time and Fortune had hyped it. Morgan Stanley invested millions. He got hooked, bought near the peak, and lost everything when the company burned through $135 million in 2 years and went bankrupt. Avoiding those kinds of terrible mistakes. That's probably the single most important factor in preserving and growing your capital over time.
Okay, so the dot-com bubble was this huge stock market spectacle. But the early 21st century had another crisis brewing, one that maybe hit even closer to home for the average American: the housing bubble. This wasn't just about stocks changing hands. It felt like the very foundation of the financial system shifted almost overnight. Can you explain that fundamental change that sort of set the stage?
That's a really critical point because for most people, their home is their single biggest asset. So when housing prices cratered, it hit household wealth directly, profoundly. And the bursting of this bubble, it nearly paralyzed the entire U.S. and international financial system, led to a really deep, painful recession. The fundamental shift you're asking about, it was how mortgages were handled. The old way, maybe for decades, was originate and hold.
Meaning the bank that gave you the loan kept it.
Exactly. Banks kept the mortgages they wrote, which made them pretty careful about who they lent to, right? They verified your income, they required a decent down payment, they had skin in the game. But the new system became originate and distribute.
Okay, originate and distribute. So banks would write the mortgages, and then what? They didn't hold on to them?
Nope. They'd hold them for maybe just a few days, sometimes hours, before selling them on to investment banks. These investment banks would then bundle thousands of these mortgages together into complex products called mortgage-backed securities, or MBS.
Okay.
And then they sold these MBS pools to investors all over the world. Pension funds, insurance companies, you name it. It was sophisticated financial engineering, or maybe, financial alchemy is a better word.
Alchemy sounds about right. And these mortgage-backed securities, they were then sliced and diced even further.
Oh, yeah. Into different tranches. Think of them like layers of risk. You'd have senior tranches at the top, mezzanine in the middle, equity tranches at the bottom. And here's the magic, or the danger. Even if the underlying mortgages were pretty low-quality subprime stuff, the top tranches could still get AAA ratings from the credit rating agencies, the highest possible rating.
How could that happen?
Through diversification and structure, supposedly, but the complexity didn't stop there. They created credit default swaps, or CDS. Think of CDS like insurance policies on these bonds. If the bond defaulted, the CDS seller would pay the buyer. AIG was a massive seller of these things.
So insurance, that sounds safe,
But
right?
here's the catch. The issuers, the sellers, like AIG, often didn't have nearly enough reserves set aside to actually pay out if things went bad. And even crazier, you didn't even need to own the underlying bond to buy CVS insurance on it. You could basically make a side bet that someone else's investment would fail.
So people were betting on failure.
Massively. This swap market ballooned to something like 10 times the value of the actual underlying mortgage bonds. It made the whole global financial system incredibly interconnected and far, far riskier than anyone realized.
It just sounds like a house of cards waiting to fall.
Hmm.
What did all this demand for mortgages to package up do to lending standards? Were they loosened?
Drastically, utterly. If you're a lender and you know you're selling that mortgage off in a few days, you have much less incentive to care if the borrower can actually repay it.
Right, the risk is passed on.
Exactly. So we saw loans issued with zero down payment based entirely on the assumption that home prices would just keep rising forever. We even had NINJA loans. That stood for no income, no job, no assets.
NINJ loans, you're kidding.
Not kidding. And no DOC loans, where lenders didn't even bother to verify the borrower's supporting documents. Income, assets, just take their word for it. With money flowing this freely, home prices just soared. It became a self-fulfilling prophecy for a while.
And wasn't there also a role played by government policy in all this?
A significant one, yes. There was pressure from Congress to expand homeownership, which is a noble goal in itself. But it led to agencies like the Federal Housing Administration starting to guarantee mortgages for lower-income borrowers, sometimes with looser standards. By early 2010, studies showed nearly two-thirds of the bad mortgages originated during the boom were linked in some way to government agencies or regulations pushing for expanded homeownership.
So it wasn't just predatory lenders.
It wasn't just predatory lenders, though they certainly played a role. It was also government actions and policies that contributed to loans being made to people who, tragically, really couldn't afford to repay them long term. The incentives were skewed all around.
So just how big did this housing bubble actually get? How out of line were prices compared to history?
Well, look at the Case-Shiller Home Price Index. It adjusts for inflation, and it tracks prices across 20 major U.S. cities. For the 100 years before this period, inflation-adjusted home prices were remarkably stable. They didn't really go up much faster than overall inflation. But in the early 21st century, this index doubled. Inflation-adjusted prices doubled. In some hot markets, like parts of California, Florida, and Nevada, prices rose even more dramatically. It started looking strikingly similar to other bubbles. People weren't buying homes just to live in anymore. They were buying them to quickly flip for a profit, assuming prices would just keep going up.
And like all bubbles, eventually it had to burst. What was the fight out when this one finally popped?
The damage was just immense. Home prices fell across the board. In some of the hardest-hit areas, they fell by two-thirds or more from the peak. Countless homeowners suddenly found their mortgages were way higher than the value of their homes. They were underwater. This led to waves of defaults and foreclosures. You heard about jingle mail, people literally just mailing their house keys back to the bank because they couldn't afford the payments and owed more than the house was worth.
It's heartbreaking.
It wiped out trillions in homeowner equity. It bankrupted major financial institutions like Lehman Brothers, Bear Stearns, required massive government bailouts for others like AIG. Credit completely dried up. Banks stopped lending. And that led to a really painful, protracted recession, the worst since the Great Depression in terms of its intensity and length.
So stepping back and looking at the big picture now, we've got the dot-com bubble, the housing bubble, different assets, tech stocks versus real estate. But they seem to share some common threads, don't they?
They absolutely do. A key lesson is that when bubbles burst, the real economy, jobs, spending, production, invariably gets severely damaged. And the harm is particularly bad when bubbles get tangled up with credit booms and widespread leverage. Leverage used by consumers taking out huge mortgages and leverage used by the financial institutions themselves. The U.S. experience in the early 2000s is a perfect illustration. Growing housing demand pushed prices up. Higher prices encouraged more mortgage lending, often looser lending, which fueled more demand and even higher prices.
That positive feedback loop again.
Exactly. Fueled by easy credit and increasing leverage all around.
And then when the bubble bursts, that whole positive feedback loop violently reverses.
Precisely. Prices fall, wealth evaporates, mortgages go underwater, loans go bad, people get scared and cut spending drastically. Highly leveraged financial institutions, they scramble to deleverage, sell assets, reduce lending. This leads to a credit crunch, which further weakens the economy, resulting in a severe recession. The takeaway: bubbles linked to credit booms are profoundly dangerous to the real economy, much more so than maybe just a stock market bubble not fueled by debt.
Given all this craziness, all this irrationality, the massive destruction of wealth, does this just blow the whole idea of efficient markets out of the water?
It's really tempting to think so. It looks like madness. But maybe the core lesson isn't that markets are perfectly efficient minute to minute. It's that they do eventually self-correct. Slowly, sometimes painfully, but inevitably. They tend to recognize true underlying value. As Benjamin Graham, the father of value investing, famously put it. In the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Voting versus weighing.
Yeah. Popularity versus substance. True value, which ultimately comes down to the present value of a company's future cash flows, that's what gets weighed in the end. It always prevails.
But how can markets be even remotely efficient if they make such completely bizarre errors? I mean, valuing .com companies as if they'd make profits in the afterlife, or the whole three-compound pilot absurdity. That seems like a massive market failure.
Look, market prices will probably always be wrong to some extent. Why? Because forecasting the future earnings, future cash flows, is incredibly difficult, maybe impossible to do perfectly, and figuring out the right discount rate to use is also really uncertain. However, the key insight of efficient market thinking, I think, isn't that prices are always right. It's that at any given moment, it's incredibly hard for any single person or institution to consistently know more than the market as a whole.
So you can't consistently outsmart the collective.
It seems not. Even the best and brightest on Wall Street, the hedge fund gurus, they can't consistently pick undervalued stocks or avoid overvalued ones year after year. There's just no consistent way to beat the collective wisdom or folly of the market by betting against it. You might get lucky sometimes, but consistently. The evidence says no.
Okay, what about the housing bubble then? People buying homes they clearly couldn't afford with NINJ loans. How does that fit with any kind of market efficiency? It just feels like the market was completely irrational.
That's a really fair challenge. But the housing market's collapse didn't necessarily destroy the efficient market hypothesis entirely, maybe because the incentives were so warped. Think about it from the individual borrower's perspective for a second. If you could buy a house with zero down payment, paying a somewhat inflated price might have actually been a rational decision for you.
How so?
Well, if prices kept rising, you made a profit on essentially zero investment if the bubble burst. You could just walk away, do the jingle mail thing, and leave the lender holding the bag. The losses weren't yours, they were the lender's or whoever bought the mortgage down the line.
So the downside was limited for the borrower, at least initially.
Exactly. The incentives were just completely abnormal. Regulation was clearly lax. So while it looked like madness, the housing bubble wasn't necessarily caused by blind faith in efficient markets alone. It was a complex mix of human psychology, greed, fear, perverse incentives, and, systemic regulatory failures.
So after diving deep into these two monumental financial bubbles, the .com crash and the housing crisis, what's the single most important takeaway for listeners, for you and me, trying to navigate our own financial lives? What's the key factor in preserving and growing capital over the long haul?
It sounds almost too simple, but I genuinely believe it's the ability to avoid terrible mistakes.
Avoiding the big screw-ups.
Exactly. It's so obvious, yet so easily overlooked. That siren song of quick wealth, It's fueled by hype, media frenzy, the fear of missing out. And it leads smart, otherwise rational people to make incredibly foolish decisions, like my friend with Boo.com.
Right.
Focusing on not losing big is maybe just as important, if not more important, than trying to win big.
So after unpacking the .com and housing bubbles, the common threads seem pretty clear. You've got this intoxicating mix of new opportunity, whether it's the internet or new mortgage products. You've got basic human psychology, greed, fear, herd behavior, and often some misguided financial engineering thrown in. But reflecting on all this, what stands out most to you from these deep dives?
For me, it really comes back to the enduring power of Ben Graham's wisdom, that idea of the market as a weighing machine. It might take time, sometimes a painfully long time, but eventually the market does weigh the substance. It figures out the true value. So the real question for every investor, for everyone listening is, Do you have the discipline, and maybe more importantly, the patience, to wait for that true value to emerge? Or are you going to get caught up chasing the fleeting illusion of some get-rich-quick scheme?
That's a powerful thought. And it raises a really important practical question. If the market is ultimately a weighing machine, how do you actually go about estimating that true underlying value? How do you weigh the substance? Well, we'll be diving into that very question, the tools and techniques for valuation, in our next deep dive. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.